Welcome everyone to today's leadership lecture series. The topic for today is LLS. For today's LLS is the normal distribution is abnormal. Here's a brief bio of the speaker today. Mr. Satish Ramakrishnan graduated from IIT Madras in 1987 with a B.Tech degree in electronics with a minor in physics before IIT started offering minors. He remembers mostly the classes of Professor Balakrishnan and Professor Antony Reddy for having set his brain straight. He moved to Cornell for a Ph.D. in theoretical condensed matter physics, where he worked on an interesting problem in one-dimensional conductors called charge density waves. The project was in close collaboration with an experimental group, which was quite an interesting experience for him. After working at Cornell for 2 years building laser for a biophysics group, he decided to move to become a quantitative analyst at Citibank in the commodity derivatives in New York. He later moved to Deutsche Bank, where for several years he ran a group that priced as well as marketed structured financial products to institutions and companies. Since 2007, he has been head of risk as well as pricing for Deutsche Bank head fund lending division. In this capacity, he has had frontline exposure to the travails as well as the cause for global financial crisis of 2008, which he hastens to point out was not caused by him. He maintains his interest in physics and other quantitative subjects and would rather attend physics summer schools than go on summer vacations, something his wife and 2 daughters are aware of and sometimes successfully countermand. Now I would like to invite the speaker to take the proceedings further. Thanks.
So thank you for the invitation to IIT Madras to speak at this lecture series. It's an honor to speak in front of you all. And I'd like to especially thank the team at the Alumni Relations Group, as well as Dean Professor Nagarajan and the director for starting this lecture series. I frankly wish I had something like this growing up here. But I suppose since that was such a long time ago, there were far fewer people to invite. I graduated from here in 1987, and I remember many things vividly. Among these things, among the people I do remember are Professors Balakrishnan, who is here today, and Professor Antony Reddy. Both were inspirations to me for their teaching and lecturing style, for which they are well known worldwide, as well as their insistence on being independent thinkers. They certainly lived what they believed and were great examples to all of us, even those of us who had a very large opinion of themselves. I'm going to speak today about something I first heard from Professor Balakrishnan. He's himself worked in the area of non-equilibrium statistical mechanics, so I'm glad to say he knows most of what I'm going to speak about today. But it is a realization that I came to through watching from the front seat how people make such incorrect assumptions about the probability of extreme events and how it causes chaos in the world or their own lives. Conversely, this causes them also to underestimate the probability of success through extreme events and causes them to be too conservative. It's tough managing risk, and it's a useful skill to learn since it is such a widely required talent, all the way from building experiments in a scientific lab to deciding what field to do research in, what product to invest in, what product to disinvest in, who to marry, and so on. I'm going to speak about the central limit theorem. First, I'm going to start by telling you why you should listen to this talk. Once I've convinced you to stay, I'll talk about the theorem, which I'll give you a little example that you can do in your favorite Excel spreadsheet to reproduce the theorem easily. After this, I will lead you through a few counterexamples, 3 counterexamples, and then point you to some more places where counterexamples exist. This is going way too fast. I think it seems to have decided to go ahead on its own. Okay. Later, I'll speak about some of the most commonplace violations of the central limit theorem, which is why crashes occur in the stock market, and show you a simple puzzle that really illuminates how crashes occur. Then, in the style of one of my favorite people in this messy world, Dr. Abdul Kalam, the ex-president of India, I'll supply you with a reading list of books that you should read, even if you find my presentation boring. First, why should you listen to this talk? Let me go to the next page. Okay. So most of you will do something different from what you studied in college. That's what the statistics that I've been flooded with by Abhishek Sharma, who organized my talk here, proved to me, and I knew myself. Many of you will work in fields that are rather new. In fact, things that didn't exist when I was in IIT. I just added a list of things that that we had no conception of. The internet, iPhone and phablets, laptop computers, cell phone videography, Skype, Wi-Fi, driverless cars, smart grids, driverless planes, nanometer scale fabrication techniques. Adblock is the tallest building in Chennai. That was true when I was here. Most of you will start your projects with a lot of optimism and a lot of hope, and they'll be in fields that you don't know much about. So the thing that is worth remembering is that things foul up for the strangest reasons. And the reasons they usually foul up is an unholy reliance on the central limit theorem. So before I go further, I want to explain to you, since some of the examples I'm going to use are from finance, I want to explain to you a few basic concepts in finance. Not enough to give you a Ph.D. or an MBA, but at least to get you through the stock. First of all, if you own a stock, you're supposed to be long the stock. Okay, that's the definition of the word long. If you've borrowed somebody's stock and you've sold it in the market, and you've borrowed this for a few days, months, or years, then you're said to be short the stock. A call option is the right to profit if the stock price exceeds a certain price. So if, say, you have a call option struck at 100, if the spot price of the stock ends up at 105, you make $5. So this is called a call option. A put option is one where you have the right to profit from a decline in the stock price below a certain strike price. You can be long a call or short a call, long a put or short a put. So all these are four simple concepts you need to understand. So what is the central limit theorem? Okay, now when we learn something these days, the first thing you go to is Wikipedia, right? So you go to Wikipedia and you type central limit theorem, this is what you get. I removed some of the other stuff which was way too long and unnecessary. It says that if you take a lot of independent random variables and you compute their arithmetic mean, and you assume that the independent random variables have some mean of their own and some well-defined non-infinite variance, some kind of variance, then the mean of these random variables will be distributed approximately normally, regardless of the underlying distribution. Okay? So this is one that you can actually check for yourself on Excel. So what you do in Excel is you use the rand between function. I did it with 26 random variables, all distributed with equal likelihood over some range. And I added them up. And then I said, what's the distribution of the sum? And if this thing will move, then you'll... So I'm actually modeling in this situation the strongest form of the central limit theorem, which says you add random variables with different variances. Okay? So this you should all understand pretty quickly. This is the distribution of one of those variables. It's approximately equal likelihood in some range. And if you add them up, then you're... it's not moving. Okay, there we go. I think I have to be closer. The sum adds up to... There we go. Doing this very, very simply, you can start to see the distribution function looks more and more like a normal distribution. So that's where it comes from. Okay, so when you have a normal distribution, there are some features of a normal distribution. Okay, in most textbooks, you'll find that the normal distribution is referred to as N01. I think you have to move this thing forward. It's not going on its own. have to point it. Okay. There we go. It's called N01, and that means the mean is 0, the average value is 0, and the standard deviation is 1. Okay? So the interesting thing to ask is, if I have something which is distributed normally, then I have a standard deviation of, let's say, 1. If I had 1,000,000 years and I had one event happen every year, what's the number of days when a worse than n standard deviation event would occur? So the answer for one deviation, so the number of days in 1,000,000 years where a worse than 1 standard deviation event occurs is 115.8 million, roughly, days. Okay? 2 deviations, 16.6 million. Gets very, very small. As you can see, it falls almost exponentially. 3 days is roughly 1,000,000. 4 deviations is 23,000. 5 deviations, you're at 200. 6 deviations, you're less than 1. So 6 deviation events don't occur. They occur less than one time in 1,000,000 years. 7, 8, 9, 10 gets to 0 very quickly. Okay, so they are levels I could not even plot in Excel. Okay. So what could go wrong? What could go wrong with this theorem? The theorem, as it stands, is a mathematical theorem. It doesn't go wrong. It has, if the assumptions are correct, the theorem follows. But there are things that you could do that might cause a problem. If you don't add enough variables up, if you have too few variables. The second is, are the components of your sum actually independently distributed random variables? If they're not, if they're all the same variable, for instance, then it doesn't look anything like a normal distribution. Okay? Are you doing something because of your trading or because of your own actions that's causing the distribution, that's causing the random variables to become correlated? If so, again, you don't have a normal distribution. So I'm going to give you 3 examples, 3 cases that happened in the financial markets in the last 15, 20 years, which are basically examples of basically the last cause of causing the normal distribution to become non-normal. So one of them is called LTCM, which is long-term capital. I put the little m for mismanagement. The second is crowdedness, which is an example I want to show you. The third I call hedging to despair. So let's start with the first one, which is long-term capital management. Long-term capital management was a fund that had a lot of money. They were among the first large hedge funds in the financial markets. They had $4 billion to invest in the financial markets. Okay? They invested and they went long and short approximately $3 to $4 trillion of government bonds, which they went long and short. So they bought and sold. Okay. Now, $3 to $4 trillion of securities. This happened in 1998. At that time, the US national debt was about $6 trillion. So you can see this is already a humongously large portion of the US Treasury market. Their favorite trade was to buy something called on-the-run Treasury bonds. So what they did was this. In the US Treasury market, which is a market which most people may not be aware of, but it's one of the most deepest and liquid markets in the world, you can buy, the US Treasury issues bonds, issues debt every month, sometimes every quarter. They sell these bonds, and these bonds are typically maturity of 1 year, 5 year, 10 year, 15 year, 30 year. Okay. If you are an investor in the market, typically you call your broker and say, I want to buy a 30-year bond. And so the 30-year instrument, or the 20-year instrument, or the 10-year instrument is very popular. Anything close to it is very popular. Anything that is different from it, is say 9 years and 3 months, isn't popular. They're called off the run. Now, because the on-the-run bonds are in great demand and are easy to sell, they have a lower price than the off-the-run bonds. Not for any fundamental particular, any real reason. So what these guys did was they would buy the 30-year or the 20-year or the 10-year bond, and they would sell something close to it in maturity, maybe a 20-year and 6 months, bond against it, or a 19-year and 3 months bond against it. The logic was that these two bonds should have very similar prices, but they were different by about, let's say, on the units of treasury bond prices, maybe 0.25 or 0.3 out of 100. So around 30 basis points, 0.3%. Okay, if you do this and you think that the people holding these two securities are independent people, somebody buys this and the price goes up, somebody sells it, the price goes down, somebody else buys the off the run and the price goes up, somebody else buys this and the price sells it, it goes down in price. There's uncorrelated variations. So the logic was, if I buy this and sell this, eventually they'll all meet at the same price in 20 years, 10 years, 15 years. However, in the meantime, there'll be some noise in the markets. The problem was, what happens when you buy that kind of size of this security? Everybody else knows that you're buying. You're buying the on the run, selling the off the run. What's more, all the lenders who lend to your banks are people. They talk to each other, and they will tell people, this is a good strategy. This looks like these guys are buying a huge amount of the strategy. So everybody piles onto the strategy. Okay, this is the problem. Now suddenly, when you buy, everybody else is buying with you. When you sell, everybody else is selling with you, because they know that you are the one who decided that the strategy makes sense. It's a perfectly good strategy, but as soon as people know that you're doing it, they all correlate the price variations. The distribution of valuation differences in the long and short positions are no longer distributed normally. In fact, the large participants in the market aren't the ones who matter, because they will never sell their strategy till they're forced to. The little guy, somebody mom and pop buying a few bonds, doesn't matter. It's the medium-sized person that has an incredible effect on the market. So what happened was they lost all their money in about a period of 5 days, essentially because as soon as one medium-sized person got nervous about the market, got out of this position, all the bond prices moved enough that they had to reduce the amount of leverage they had in the market. They had to sell out of their position. Everybody else sold with them, and then the prices deviated even more from each other, which was again a silly position to be in. But the people that profited were not the hedge funds, it was the banks, because the banks bought it off these hedge funds and said, we'll just hold on to them till prices recover. So they lost all their money in 3-4 days. So it was quite an event, and quite an example of how something which was initially assumed to be normal isn't normal anymore. So let me go on to the next example, which is actually very similar kind of thought process. I think this thing is given up the ghost. There we go. I've actually met more physicists in this business than I have met I've met more famous physicists in this business than I've met through actually doing physics. So one of the interesting strategies that people practice is it's called statistical arbitrage. So what people do, and it's one that a lot of physicists and mathematicians are really specialized in. Jim Simons is very famous, a billionaire multiple times over, who started this fund after he quit as head of the department at Stony Brook, and has been a very successful manager of Renaissance for at least 20 years now. George Zweig, who was well known for having invented the model of quarks before Murray Gell-Mann, recently began a new fund which also has a similar strategy, and there are a few others like that. Okay, so what they do is they buy a very large portfolio of a lot of stocks, small numbers of lots of stocks, and they sell an equally large portfolio of lots of stocks, same size on both sides. Okay, this portfolio that they have is exquisitely risk-free. So it's got very small numbers of shares of lots of names, long and short side, very little actual sector concentration, very liquid, absolutely no risk from what you would tell, from what you would look at, because you would think if the market were to fall, all these stocks will fall together, and so you'll lose on your long side, but you'll make on your short side, so you don't make any money. You don't lose or make any money. The problem is, this portfolio is traded also based upon various market signals, and if you look at the the price returns, the price returns are between 3 to 4% deviation, which means really if you're, and the amount of money that they make is so constant, they make roughly 10 basis points per day, 0.1% per day. So it's very steady gains with minimal variation. Now 3 to 4% annual standard deviation means on a daily basis you should never expect to lose 30% or 40%. However, because that's hundreds of standard deviations, as you know, the normal distribution says you should never, you should have never expect more than 6 deviations in a million years, and if you do, then it's not normal. Okay, so now what happens? It turns out that this happened in 2007, quite famously, and happened more than once for several funds. These particular funds were saved because they were very careful, but many others closed down completely because they lost all their assets. They lost all the money. So why did that happen? Well, what's happening is the way these models work is that the analyst looks for factors that drive the market, the long and the short side. So the factors that drive the market are, here's an example. If something has gone up for the last 5 days, it'll probably come down. That's a simple algorithm, which you might have discovered after working on several markets in certain geographies. Okay. This is called, by the way, mean reversion. So now everybody has a mean reversion idea in their toolkit. So if you have a stock that's gone up 5, 6, 7, 8 days in a row, it's likely that it's a part of everybody's portfolio on the short side. If so, what differs between the portfolios is not the names, it's the sizes of those positions. But the same names appear on the long and short side. This means that if one medium-sized person gets out of the market, decides to close down their portfolio, everybody's portfolio is affected. This is called crowding, and it's become a factor of all the markets globally. You will often find that everybody's portfolio has some favorite names, and when 1 or 2 people that are fairly big in this market sell those positions, it affects everybody's positions because those positions get marked down in value when you sell a large chunk. So yet again, you're seeing how correlation between various stock prices changes the distribution of those stock price returns, and makes and this is again a situation where you have a distribution which could be normal if you had small positions in this held by a lot of different people, but once it's held in large chunks by the same kinds of people, it changes the distribution shape. Okay. So I'm going to go and talk about this third example, which is actually very interesting. This is a repudiation of standard finance theory. So in finance theory, when there are often investors that will buy a call option on a basket of stocks. So now what is that? I don't know which stocks will go up, so I buy an index of some sort, say the Nifty index, or a basket of stocks of some sort that is constructed for my purposes. The payoff is the expected positive return on the basket. So it's basically how much will the basket go up in price minus the strike price is my return at the end of 1 year, 2 years, 3 years. So that's the formula for the payoff. It says look at the return of every stock and subtract it from the initial price, and that's the average return, and you look at the positive value. This is called a call option on a basket. Okay. So I've drawn here, which hopefully it will show up when the machine works. A graph of the price of the call option. It shows you what the price is at expiry. So it goes up above the strike price, and below it's not paying you anything. Okay. So finance theory says it says you assume that the stock prices are distributed log normally. What does that mean? Well, stock prices can't go negative, hopefully. It never happened before. So the log of the stock price can be assumed to be a normally distributed variable. So people say use a normal distribution for the log of the stock price returns, and then compute the value of the call option using this assumption. So what you assume is then you assume a correlation between each pair of stocks. Okay. So far so good. This is what standard finance theory, if you go into any book in finance and how to price options, this is what they tell you to do. The problem is this. The book tells you buy the basket if the basket price goes up, because it says the way to hedge, the way to price an option is to replicate the portfolio using underlying stocks. And so you replicate it using stocks in varying amounts, and you buy more as the option becomes more in the money, more as the stock price, as the basket price goes up. So your option hedge formula will tell you to go buy more of the stock as the stock price goes up. Eventually, when the stock price goes up very, very high, you're buying the same basket. If it goes up $1, you buy $1 more, because you have to pay out $1 more. But what does it mean? It means that as soon as you buy one stock, you're buying all the other stocks with it. Okay, that drives, and if you're large enough in this market, you are making the prices correlate by your actions in the market. You're buying one, and then you're buying the other one, at the same time. Right? Your orders to the market are buy the entire basket. Okay, if your hedge is big in size, you're forcing the stocks to correlate positively. What's more, if you sell one, you don't just sell one, you sell all of them together when the price goes down. So now your activities have caused previously independent variables to have higher correlation amongst themselves. Yet again, you've changed the assumptions that made the distribution log normal in the first place with a correlation function. Okay. Finance is therefore too difficult a subject to be left only to the economists. It's one that really it needs a lot of behavioral science, it needs neuroscience, it needs obviously my own background, physics and math. But it's one that happens a lot. So there's an example of this already from mathematics in the past, and people have invented the power law distributions to explain this sort of behavior. And if you look at Wikipedia, you'll find something called the Pareto distribution, which is a power law distribution for how many small things happen, but a few large things can happen. And it's been checked, and people have done tests of how sizes of sand particles and length distributions of jobs assigned at supercomputers, or our IBM 370 when it used to exist. Or the 80-20 principle, which is the principle that 80% of the population has 20% of the wealth. Conversely, 20% has 80% of the wealth. These days, that principle is known as the 99-1 principle in most countries, because of the way in which equality has been destroyed in the markets, most countries. So power law distributions are in fact more common than normal distributions. And I'll give you two examples. Both are, by the way, examples that I made up. So don't assume they have, well, one is an example that I made up. It's an IIT and fortune distribution, which I want to completely be very honest. It's not a measure of happiness or of smartness or anything else, since I don't belong in that distribution anyway. It's a financial distribution. Okay? It's a math problem. It's a math toy problem. I look at IITians 15 years after graduation. Okay, and this is my own example. I assumed that their salaries are distributed log normally, because nobody, as far as I can tell, has a negative salary. So I assumed mean salary of $200,000, which may or may not be too low. I assumed a standard deviation of $200,000, which again is not out of the question. It sounds like a reasonable number. How many billionaires do you expect? That's 5,000 standard deviations away. Even if your standard deviation number was wrong, you expect 0 billionaires. I know from my own informal calculation there's at least 4 or 5. So this is actually not a normal distribution at all. In fact, it follows more like the Pareto distribution with an alpha equal to 1, alpha from the previous power law distribution. Another example, which I think is actually far more scary, is climate change. If you look at climate change, and you look at most of the calculations of what these models tell you for what will happen to global temperatures, they all tell you the temperatures are going to get higher. So between 1 and 2 degrees Celsius is expected widely by the end of the 21st century. Okay. So the mean will shift is what they're telling you. As far as I can tell, there's much less knowledge, modeling, and evidence about what the distribution will do. Okay? So if you look at this, if you assume that the distribution becomes more becomes more broad, you'll have more extreme hot weather or more extreme cold weather. And so the distribution could shift and could therefore give you, it could shift in a funny way, it could shift higher with the peak moving lower, and so you actually have less extreme weather. It's not clear from the simulations thus far that the distribution will shift one way or the other, and which way, what will happen to extreme events. The problem is, should we worry about the shift in the mean or the shape of the distribution? Both are relevant to the answer. If you look at the distribution functions, I picked this up, by the way, off the web. On one of the websites, I follow a blog about climate change. I have no idea why this person who wrote this paper thinks the distribution has to be normal. Absolutely no evidence that says that it has to be normal at all. And also, look at what people do in hot weather. Right? In most countries, they turn the AC on. What happens when the AC goes on? The power plant that produces the air conditioning unit's electricity has to generate more power, which means you're producing more carbon dioxide into the air, which causes more hot weather, as we know. So there is positive correlation between the actions you take when there's hot weather and the hot weather itself, which to me indicates that the distribution has more likely to be fat-tailed and not at all normal. I have no evidence either way, but this is something which is worth thinking about. Okay, so I have a bunch of questions I've raised here, which is that the distribution of stock prices and how prices move in the markets aren't normal at all. But one of the questions that people have when they study markets are markets ever in equilibrium? Is there a day when markets are actually not doing anything, and if so, why do they suddenly begin crashing, for instance? Right? If they are in equilibrium, why do they crash? Why is there illiquidity in even the best stocks sometimes don't trade in the markets? Why does it take some time before bad news causes stock prices to crash? Sometimes, for instance, we knew about the Chinese over leverage for many years. Why did they crash? Why did the stock prices only crashed last month? What took it so long? Why were people buying bankrupt companies as they were crashing? So Lehman and Enron, people are buying these stocks as they were crashing. Some other questions which are interesting. How come Buffett does so well? He's been investing for the last 70 years, 50 years or so. He's now a billionaire. Some of the examples people give you is, if I have 1,000 people lined up in a row and they all toss coins, and I eliminate anybody who gets a hedge. Okay? So after one round, I expect 512 people to leave. After 2 rounds, I expect 256 people to leave. At the end, after 10 tosses, 1 person is left. Is that person lucky or smart? So these are questions that you probably have and you should have about the markets. Is that what's the reason why the markets behave this way? Should you believe that there is no point in having intelligent investors actually invest in the market for you? What's the point? So I'll give you an example of a crash, which I think is best exemplified by a puzzle that I heard about some years ago. Let's say we have an island with 100 couples. Okay, so man and woman, 100 couples in the island. So the rule is this: once a woman discovers that her husband has been unfaithful, she kills him that same evening. And that's the rule. Okay. When a man is unfaithful, everybody, all the women, except his own wife, know. Okay, so this is simple. Suppose all the people have been told that at least one man has been unfaithful. But let's say only one man has been unfaithful. What happens? Well, One more question. So, since that one man's wife doesn't know, but she knows that one has been unfaithful, she knows nobody else, so she knows it's him, and so she kills him the next day. So the same evening he's slaughtered. Okay. What happens if there are n men that are unfaithful, and let's say n is 2? So since all they've been told is that at least one has been unfaithful, okay, the first day, one of the women knows the other person's husband is the bad one, so she's going to wait that day. She has no idea that her husband is unfaithful. The next day, she realizes nothing happened to that guy, so that means my husband must be the problem too, because that's why she's looking at me and saying, well, it's your problem, right? So the second day, these both kill their husbands. Okay, and if it's n men, it happens after n days. Very, very simple puzzle. Do you all follow that? Okay. So here's the question for you. After n days, you have a crash. All you knew was one is the problem. The information flow is extremely logical. It makes perfect sense, but it's completely invisible. If you wandered into the island one day and you heard one is unfaithful, who knows? Who cares? But suddenly, after n days, you find the mass murder, right? This is a very interesting puzzle because it shows you why, for instance, you could have information in the market, but absolutely no action in the market because people are deciding what to do. They have no idea what to actually do. They have no idea if they have enough knowledge to make the decision that they have to make. So, as an example of understanding how markets move, one example I find interesting is look at a forest. Is a forest ever in equilibrium? In a forest, typically you have you have a few things. You have fires of various sorts. You have predators, which are eating prey. And the population of the predators and prey oscillates, right? Because if there are too many predators, then the prey get eaten and there are fewer of them. Next year, there's not enough food, so the predators die, and the prey population goes up. So this is a well-known model in physics and mathematics. There's a model called the Lotko-Volterra model, which you can look up in Wikipedia again. The fear index, if you want to build a model for the financial markets, you can invent an index called fear, an index called greed, and when there's too much greed, the markets go up, but then there's fear. So fear eats greed, and greed allows fear to go to a certain point. So it's a little like the population prey, the predator prey model, and it allows you to explain why the markets do what they do, which is oscillate up and down between various points of various equilibria. Now, this also explains to you all the things that people do to try and protect the market. So, for instance, in China or in the US in 1974, when they had an oil shock, President Nixon famously put price controls on the price of oil and said, you can't sell the oil for a higher price than this. That's called price controls, and you've seen this before. It's in the forest. You might build a zoo for the leopards, for instance, or should you shoot all the predators, or should you build a zoo for the deer, for instance? I mean, so it's a bunch of strategies which people do in the forest. Also has complete analogies to what people do in the markets. So I've shown an example here of how the prey population goes up. When there are fewer prey, there are more predators. Sorry, there are more predators, the prey population falls, then their population falls, and the prey goes up again, and so on and so forth. So, okay. So, I guess the point I'm trying to make is financial crises rarely happen because of one specific event. It's not often one thing that leads to a crisis. Often it's a distribution that changes shape from purely normal to one that is completely non-normal because of the unintended pressure of several participants in the market that unintendedly correlate themselves. So there's a law called Murphy's Law, which you again may have heard from Wikipedia or the internet, which says anything which can go wrong will go wrong. I have a reformulation which is not as nice to read, but it's actually far more useful to me, at least. It says once something can go wrong, but only improbably wrong, dependencies will build up that will directly cause the probability to rise. So that the previously improbable thing will definitely happen with consequences that are catastrophic. So it's really that once you rely on something that could go wrong once in a while, you over-rely on it, and then it fails on you. So if you're a regulator in the markets, what do? Should you put laws about who can speculate, who can't speculate? Most regulators simply do the obvious thing, which is to regulate the size of the problem. So they just say, you can do this, but you can't do this in more than a certain size. That is what the US regulators did, and those in Europe as well, those in India, which was to reduce the size of the problem. The Chinese have done a different thing. They have said, we actually want the market to become even bigger, but we want to regulate the size of the problem by simply making it difficult for you to talk to each other. So you can't sell your stock. You can't buy too much of a certain number of shares without telling us. So it's a different approach, and it's not clear to me that will work necessarily any better. But it's an area of research that people, I think, haven't spent enough energy and time on. So I was told to give some career advice, which I always tend to shy away from because it's not clear to me what to tell people that are starting out. Given, as I said, that what you will do in 10 years or so will be quite different from what I ever thought was possible, or you ever thought was possible. But one thing I think I can definitely say is that you should aim high in everything you do. There's no point in aiming low. The second thing is, I think the key thing about a place like IIT is you have the chance to learn to think, and you really have to learn to think. Don't just learn a trade. That's not that you can do in your spare time. Learning to think comes after a lot of thinking, and that takes time. In addition, there's some bad news. Bad news is, despite trying as hard as you possibly can, you may not succeed in doing as much as you possibly want to do. But you will have a lot of fun doing it, and that's important. The good news is that you are more likely to succeed than your peers or parents or anybody else tells you, because people think normally. They don't think abnormally. They don't think in the way that the world actually works. The last is a little long. You are actually participating in humanities' rather difficult process of selecting the few to educate. You're doing this not for your ancestors, but for your future, for our humanities' future. So you have an obligation to succeed in doing this. And don't listen to your elders unless you thought about it and you agree. That's actually helped me throughout my life and really helps me a lot. So since I promised you a reading list, here's one that I think I found very interesting in preparing this talk. The first two by Nassim Taleb are very famous and are justifiably famous. They're very well written. John Allen Paulos is a mathematician at UPenn, and that book that I write there is actually the one from where I got that puzzle years ago. Feynman's commencement address is very, very inspiring to read, and you should read it if you find it on the web. And I got the graph on the climate change from this blog, which I can send you if you want to look at it. That's really it. Thank you very much for listening to me.
Thank you, sir. Now we are open for the question and answer session. We would like to have questions from your side.
That was an excellent talk. Thank you very much.
Thank you.
And most interesting. I learned a lot. There's one comment I'd like to make, which is two distinct aspects to it. One of them is the actual distribution of correlated events and the failure of the central limit theorem and so on. The second is a different problem, which is the distribution of the extreme events. And as you know, the extreme value distributions in classical statistics fall into three families, right? The Bible, the Gumbel, and the Weishart Frechet distributions. And that's actually a much more robust thing than the central limit theorem itself. Because even if you have correlated random variables, you'd still be in the domain of attraction of one of these extreme value distributions.
Yes, yes.
In this case, for positive values, maybe I don't know, remember the name, Frechet or whatever it is, right?
Yeah.
So the question is, under what sort of correlations would that get destroyed? And there it turns out that even if they're extremely strongly correlated in some sense, say the correlation falls off like 1 over the log of the distance between in sample space, even then it falls into the domain of attraction of this. But interestingly enough, if there's a combination of deterministic but chaotic dynamics and stochastic underlying noise of some kind, then all bets are off. And things like this can happen. So there can be long periods of quiescence followed by sudden fall into chaos. So things could be poised on the edge of chaos for a long time. So my specific question is, the strategy which one uses for control of chaos, which is what any acrobat does when you balance a stick on your finger, you actually move the unstable fixed point so it lies under the center of gravity, lies under that. Can something like that be used here so that you actually have an unstable fixed point all the time, but you're moving it by changing parameters so that you're safe from toppling over? So would something like that work, some strategy?
What you're asking is, can you always succeed in the financial market, or at least succeed in some positive, at least enough of the time that you don't overall lose money? It's a very difficult question to answer because the markets haven't been around for that long. I mean, 70 years, 80 years is not long enough. There have been cases where people and plus people don't participate once they are bankrupt. So so the only experimental evidence you have is from the success stories. You have a bias. So the experimental evidence is very, very hard to come by. The difficulty with using a model like this in this situation is also the number of inputs you need. So here's an example. I find this fascinating because finance is a little like particle physics. You collide two particles and they bounce off each other. Then you use a little more energy and suddenly you find they have structure. Now the molecules break up into atoms. Then you break up some more and suddenly now the atoms start breaking up into electrons and protons. Then you hit them again and now suddenly you find new particles being created out of nothing. And so the dynamics in finance is changing. Who could have thought that simply using the laws of probability to design a CDO, which is a way in which you take bonds that are very risky and make a small number of very high quality bonds by making sure that you get all the coupons from the risky bonds into the high quality bonds. So this way you are converting dross into gold. Who would have thought that people would put mortgage bonds into these, making unjustifiable assumptions about the mortgage bond security, and then destroying the entire market that way? It's a strategy which works in one market will not necessarily work in a different market. In fact, will often fail catastrophically because the assumptions that you make are for want of ability to build a model. You will make some assumptions. Those assumptions are the ones that often fail in these situations. So if Jim Simons' fund was the only fund running the strategy, there's no problem. He could do whatever he wanted. The moment others joined and realized that he's making money, the market changes, and now you're in a different regime where now somebody else is doing what you're doing. I think that to me is the part that makes the human element far more involved. I don't really see a way of modeling that for any length of time. I mean, over a short period, yes, I'm sure that an extreme value distribution of the right kind, with the right dynamics, with the noise thrown in, which is obviously important, is really important. But I think the number of variables itself changes. The equations, the basic state space changes from what it was before to what it is now. That is very hard to model. And I think that's why humans have succeeded where computers really haven't in this space.
Now would like to invite Dean Nagarajan to come on the stage and present a token of appreciation to Mr. Satish.
Thank you. No, I don't drink coffee either. That's fine.